problem almost no one is talking about for high-income married federal employees, and it's called the widow's tax penalty. It shows up when one of you passes away and their surviving spouse ends up paying more in taxes and Medicare costs on less income. So in this video, I'm going to walk you through what this widow's tax penalty actually is, how it plays out with a real FERS and TSP case study, and what you and your spouse can start planning for today so your future surviving spouse is not blindsided. And if you're new to the channel, my name's Tom, and I exclusively work with federal employees to help them plan for retirement and make those decisions with confidence. All right, so when you're married and you file a joint tax return, you get wider tax brackets. That just means you can fit more income inside each bracket before you spill over into the next one. You also get a bigger standard deduction, and for Medicare, the income thresholds where surcharges kick in, called IRMAA, are higher for married couples. Now, when one spouse passes away, the surviving spouse usually ends up filing as single starting the next tax year. And that's when all those tax bands start to tighten up. The brackets compress, the standard deduction is smaller, and those IRMAA thresholds for Medicare are roughly cut in half. Now, the tricky part is that the income for the survivor doesn't get cut in half. What usually happens is one Social Security check goes away, and that's usually going to be the smaller one, and the survivor keeps the higher Social Security benefit. The FERS pension might drop if you chose a survivor benefit, but it doesn't go away. And required minimum distributions from the TSP and IRAs keep going based on the full pre-tax balance. So overall, the survivor has less total income than the couple had together, but that income is now being pushed through those tighter brackets and lower thresholds. That can mean a higher tax rate and higher Medicare premiums for a widow or widower on less money. This is a topic most federal employees have never really thought about, which is what actually changes when you go from married filing jointly to filing single. Most federal employees I work with have heard of the tax brackets and maybe even IRMAA, but very few have connected those rules to what actually happens when one spouse passes away. When you file married filing jointly, each tax bracket covers a wider range of income. For example, in 2026, a middle bracket, let's say the 22% bracket, for married couples runs up to a little over $200,000 of taxable income. As a single filer, that same bracket tops out around $105,000. The standard deduction is also larger for married couples, so more of your income is shielded before you even start calculating tax. And on the Medicare side, IRMAA tiers work the same way. At the base level, a married couple can have income up to around $218,000 and still pay the standard Part B premium, which in 2026 is about $203 per month per person. For single filers, that first threshold is around $109,000. And above that, the premium can jump into the next tier, which is over $400 per month. So when you move from married jointly to single, the walls start to move in on you. Right? The space inside each bracket starts to shrink. The IRMAA tiers shrink, but your income as a survivor often does not shrink as much. So let's look at how that plays out with a real example that I often see in my planning work. Here we have Mark and Lisa. They're both retired FERS employees in their mid-70s, and here's their rough picture. Mark's FERS pension is about $36,000 per year. Lisa's FERS pension is about $30,000 per year. Together, their Social Security benefits total a little over $60,000 per year. One benefit is around $36,000 and the other is a little under $30,000. Between their TSP and IRAs, they have about $1.5 million in traditional pre-tax money. At their age, their required minimum distributions add up to roughly $60,000 per year. So while they're both alive, their gross income is around $190,000 per year. They file as married filing jointly. After the standard deduction and the way Social Security is taxed, they land in a middle tier tax bracket and their effective tax rate feels very manageable. Their Medicare premiums are at the base level with no IRMAA surcharge. In my experience, this is the point where many federal couples feel like, okay, we're paying some tax, but it's not crazy, we'll be just fine. Now fast forward a few years. Mark passes away at age 75. Here's what Lisa keeps. She keeps her own FERS pension of about $30,000 per year. She also keeps a survivor benefit from Mark's pension because they elected that when he retired. They chose the standard 50% survivor benefit, so she now receives a little under $20,000 per year from that survivor annuity. On Social Security, her smaller check goes away. She keeps the higher benefit of about $36,000 per year. The investments are still there. The combined traditional TSP and IRA balance is still over $1 million. Her required minimum distributions on that money are still around $60,000 per year in this age range. So as a widow, Lisa's total gross income is now around $145,000 to $150,000 per year, and that's less than the $190,000 they were used to. But here's the trap. Lisa now files as a single taxpayer. At that income level, the top of the middle brackets comes much sooner. So even though her income is lower, more of it is exposed to higher tax rates, and her effective tax rate can go up, bumping her into the 24% bracket. Now, on top of that, the Medicare IRMAA thresholds for single filers are roughly half of the married filing jointly thresholds. The income that was fine as a married couple now pushes her into a higher Medicare tier as a widow, doubling her Medicare Part B premium. So she goes from $202 a month to $405 a month because her income will fall between $137,000 and $171,000. Lisa is alone, her income went down, but her income taxes went up in percentage terms and her Medicare premiums went up in dollars. That is the widow tax trap. So if you want to go deeper on this for your own numbers, I put together a free retirement readiness blueprint guide. The link is in the description below. It walks you through the same 7-step checklist I use with clients to line up your pension, TSP, Social Security, FEHB, and taxes so you're not guessing. Now, most federal employees I work with have a very similar income tax in retirement. You have a pension from FERS or CSRS, you have Social Security, and your largest pool of savings is usually in your pre-tax accounts. The traditional TSP, IRAs, and maybe a small taxable brokerage account you have on the side. This is a strong foundation. The trade-off is that most of it is taxable as it comes in as income in retirement. The pension is taxable. Most of Social Security becomes taxable once your income crosses certain levels, and required minimum distributions from TSP and IRAs are fully taxable. So when one spouse passes away, the survivor doesn't lose all of that. They keep the higher Social Security benefit, they keep a big portion of the pension through the survivor benefit, and they keep taking RMDs based on the full pre-tax balance. That's why I often tell couples that many advanced Roth strategies are really future surviving spouse tax strategies. The goal isn't just saving a little on your own lifetime taxes right now. The goal is making sure that if one of you ends up on your own, like Lisa, their future tax and Medicare picture will be as manageable as possible. In my experience, the pain here is not only the dollars, it's the stress, right? The surviving spouse is often the one who was less involved in the money decisions, and now they're alone. They're getting letters about higher Medicare premiums, their tax bill feels higher than it should be, and they're wondering if they can still help their grandkids and kids the way they hope to. Most of this comes from the way the system is written. Now, the good news is there are things you can do ahead of time to soften this, and that's planning while you're both alive. So what can you do about this while you're both still here? I like to think about 3 layers of planning: awareness, strategy, and implementation. Layer 1 is awareness and just having a conversation. Set aside some time together. It doesn't have to be a big thing, 15, maybe 20 minutes, and ask a few simple questions. If one of us passed away in the next 10 to 15 years, which income sources would keep going? Which pension? What survivor percentage do we choose? Which Social Security benefit would the survivor keep? How big is our traditional TSP and IRA balances right now? And you don't need to memorize exact numbers here. You just want to get a rough idea. The goal is to move from not knowing anything and hoping your spouse will be okay to having a clear picture of about what their income might look like. Layer 2 is tax location and Roth planning. For many couples, a big part of preparing for the widow tax trap is shrinking those future required minimum distributions before you ever get there. One way to do that is through Roth conversions in your 60s and early 70s. During the years after you retire and before RMDs start, you might be in a lower tax bracket as a married couple than you will be later as a surviving spouse. That can be a good window to move some money from traditional accounts into Roth accounts on purpose at controlled tax rates. Every dollar you convert now is a dollar that will not create an RMD for the survivor later. And remember, Roth IRAs don't have RMDs for the original owner. Also, qualified Roth withdrawals do not show up as taxable income. They don't increase how much of your Social Security is taxed, and they don't push you into higher IRMAA tiers. Now, to go back to Mark and Lisa, if they had reduced their pre-tax balance from about $1.5 million to about $800,000 through planned Roth conversions, Lisa's RMD might have been closer to $32,000 per year instead of $60,000. That alone could keep her under a higher IRMAA tier and reduce both her tax rate and her Medicare premiums as a surviving spouse. Now, I'll be honest, Roth conversions are not automatically right for everyone. For some of you, the best move might be doing modest Roth conversions over a number of years. And for others, it might make more sense to limit conversions and focus on keeping more cash on hand or paying off key debts. It really depends on your income, your assets, your tax bracket, and how important survivor flexibility is to you. Layer 3 is cash flow and simplicity for the survivor. Think about the spouse who is less involved in making money decisions. If that is you or your husband or your wife, ask what would make life simpler for them. Sometimes that means keeping a healthy amount of cash in the bank so they don't have to sell investments at a bad time just to cover a higher Medicare bill or a tax surprise. Sometimes it means paying off the mortgage before retirement so the survivor's required income is lower. And sometimes it means consolidating accounts so they're not managing 5 different logins and different statements at age 78. So here's a quick action step for you to take. Have what I call the 15-minute spouse conversation. Sit down and ask, if I were not here, who would you call about our money? Would you want to manage this alone or would you want a guide? And what would you want life to look like in those years and not just focus on the numbers? And listen, I get it. These conversations can be uncomfortable and weird, but they are so vital to have so you both are on the same page. Okay, to finish this up, let's turn this into a simple step-by-step plan you can actually follow. Step 1, map your income in both scenarios. Write down a simple list for while you're both alive, the pension, Social Security for each of you, plan withdrawals from your TSP and IRAs, and anything else. Then write a second list for if one of you is on your own. Keep the higher Social Security benefit, keep the pension with the survivor percentage you chose, keep conservative withdrawals or RMDs from the full pre-tax balance. Step 2, get a rough idea of your tax and Medicare impact. Even if you don't run exact tax software, ask, does this surviving spouse income fall into a higher bracket on the single tax tables than our joint income does today? Would this income likely bump the survivor into a higher Medicare premium tier as a single filer? If the answer is yes, or maybe you're just getting close, that's a sign this is worth planning around. Step 3, identify your planning window. For many federal couples, the sweet spot for making changes is between retirement and your early 70s. Those are often your best years to think about Roth conversions, adjusting your withdrawal order, or moving some money into more flexible taxable buckets while you still have the married filing jointly brackets. Step 4, decide how much of this you want to do yourself. Some of you, I'm sure, enjoy digging into the numbers and building your spreadsheets and running your own scenarios. For you, the plan might be to take this outline, plug it into your own tools, and just run with it. But others will hear all of this and just start shaking their head and would prefer to have someone walk alongside them and just explain, here's how this looks with your situation. In my experience, the couples who do best here are not the ones with the perfect plans. They're the ones who start talking about it early, make a few thoughtful moves each year, and give their surviving spouse a clear path to follow later. So if you're a federal employee within about 5 to 10 years of retirement and you want to see how this all looks with your own numbers, you can request a federal retirement blueprint at gtwealthguide.com or click the link below the video in the description. Otherwise, I'd encourage you to watch this video next on how to invest your TSP in retirement and the top 4 mistakes to avoid. So click here to watch, and I'll see you over there.